Right guys, in this presentation what I want to do is to look at fixed exchange rate systems. Okay, now a fixed exchange rate system, so let's just draw our model first of all. Let's imagine we're looking at the exchange rate, so pounds against, let's go for euros. Now what we know is we've got a demand for pounds, and the demand for pounds will be based on the demand for UK goods and services investments into the UK economy. So at a lower value there'll be high demand, at a higher value there'll be a lower demand. Then we have a supply of pounds. Okay, we supply our pounds to buy foreign currency, so we can buy foreign goods and services from across the world. At a low value, we don't bother supplying because import's too expensive. At high value, we supply as much as we can to buy those cheaper imports that are now available to the economy. And what we get this equilibrium exchange rate. It's called ER1 and Q1. And what we should all be happy with now is that at that point there, the balance of payments will balance. The demand for our currency is equal to the supply. Now, what a fixed exchange rate system is all about then, it's about saying to the other big economies across the world that the pound has got a fixed value. We will intervene to keep the pound at that particular value there. We're not going to let it fluctuate. Okay? Now, think about the benefits of doing something like that. If you can fix your exchange rate, then what this does, it promotes stability in terms of international trade. Okay, it suddenly means that when we export goods and services across the world, we know exactly, or we can predict a lot more accurately, what the demand will be, because we know what our foreign customers will pay for our goods and services. It will therefore promote us to export goods across the world. That's got to be a good thing. Bigger markets and all that, more inward flows of foreign currency because of it. But also it's good for importers. Okay, we as an economy, we rely on imports of huge amounts of commodities. But if we know what the price of these will be, we've got stability. We know exactly what we're going to be charging the shops to buy certain goods and services, and firms know they've got stability in what prices they can offer. So anything that promotes international trade will lead to more benefits of trade creation, things like absolute and comparative advantage boosting efficiency, for example. And we also get the idea of stability of prices. Many people say it will also encourage firms to invest into Britain. Okay, if you've got comparative advantage or absolute advantage, what we know here is that the exchange rate is not going to take it away. We're going to maintain that advantage unless another economy becomes more competitive, but the exchange rate is not something that will dabble with that. Okay, now what we're going to be thinking about now is, well, how do you fix your exchange rate system? Well, we do it by intervening in the market. So let's take an example. Let's imagine that we said, right, ER1 is what we're going to maintain the pound at. Imagine the demand for pounds. Shut up here. Then what we know is the pound should really be looking to appreciate or gain value. Because what we've now got at ER1 is an excess demand for our currency. Supplies at Q1 but demands at Q2. So to stop that from happening, what the government need to do, they need to bring us back down to ER1. If we are suffering from lower demand for our currency, we're at demand free, and what they've got to do is to solve this problem of excess supply. So demand is still I beg your pardon. Yeah, we've got supply at Q1 and demand at Q3. This time we've got an excess supply. So in effect, what should happen is the value should fall. So what we've got to do is to push the value back up. So let's think about how we do this and to get back and maintain ER1. stop your currency appreciating, you've got to prop up the value. You've in effect got to raise the demand for our currency. Okay, well, how do you do that? Well, I use monetary policy. Now, under a fixed exchange rate system, then what you would do, you would say to the Bank of England in this case, inflation is no longer your concern. Your concern is with maintaining the fixed exchange rate. So to prop up the value, we've got to get people demanding more pounds from across the world again. They can do this by raising interest rates. And this will make Britain a more attractive place to invest again. So what you will get with this is lots of hot money flooding into Britain, raising demand for our currency. Okay, now what you could also do as well is to use, which you could argue is fiscal policy. Governments can hold foreign currency reserves. In this case, what you would do, you would sell foreign currency to go and buy your own domestic economy currency again. So you raise the demand for your currency. So when you look at it then, you're using monetary and fiscal policy to stop that depreciation. Monetary policy, you whack up the interest rates to get foreign investment flooding back in, high demand for our currency, raises the value again. And fiscal policy, you basically hold foreign currency reserves, dollars, euros for example, and you sell these to buy your currency to push the value back up again. If you wanted to do the opposite, stop your currency appreciating, then you do the exact opposite. Okay, so what you would do here, which is kind of what the Chinese do, you would buy foreign currency reserves. So if you can sell your own currency, you are in effect raising the supply, which will bring down the value, and you're making other economies' currency stronger against yours to stop yours from getting stronger. So that would be your link to fiscal policy. Monetary policy, what you would do now, you would lower interest rates. Lower interest rates will mean hot money will flood out of your economy, and it will therefore bring down the value of your currency. Okay, right, okay, now let's think about the problems of this system then. Now, when you adopt a fixed exchange rate system, okay, you're going to get these benefits of stable exchange rates, which promote trade, maybe investment, and it might bring more confidence, therefore good animal spirits in your economy. Trouble is, it does create lots of drawbacks. So these are the problems of these different systems. You've got conflicts with other macroeconomic targets. Okay, now Britain dabbled not with a completely fixed exchange rate, but a semi-fixed or a pound system. Now we fixed the pound against the value of the German Deutschmark back in the weak 1990s. Well, in Britain, when it was fixed, it was to a certain extent an overvalued currency. So what we should know is that it should fall in value, but we didn't let it happen. Okay, we'd said it was fixed, so it had to remain fixed. So think about the problems of this then. You've got to prop it up through high interest rates and buying your currency by selling foreign currency reserves. Now think about this as a problem then. What if you've got in your economy a recession taking place and your currency should fall in value. Well, think about what you're now going to say. We're going to whack up interest rates. Well, think about what that will do. It will lead to aggregate demand falling. Britain has got high levels of sort of private debt. People got big mortgages, for example, big loans. If you push up interest rates, then borrowing becomes more expensive. People's mortgage prices start to increase at ridiculous levels. So the cost of buying property will become more expensive. Credit cards, loans become more expensive to buy. So what this will do, it will push down aggregate demand. This will obviously lead to bad impacts on employment, and therefore lower GDP as well. So great, you know what, you might have a nice fixed exchange rate, but the problem is your people back home are unemployed, output's falling because of lower consumption investment in your economy created by the high exchange rate that you're trying to prop up. What it can also mean as well, though, is that you can't depreciate. So inability to weaken. Okay, so imagine that, you know, as an economy, Britain has got a huge trade deficit with the rest of the world. Well, over time, our currency should weaken. Because what this will do, it will help us to export more and gain competitiveness. Well, here, you can't. It's fixed. So what this could mean is that you are trying to prop up a balance of payments deficit if you've got a weak currency. Where's that money going to come from? Selling foreign currency reserves, dwindling them down. Now, a lot of people said as well that the biggest problem of this is that you get speculation. Okay, let's imagine that your currency is overvalued. So what you're doing as a domestic economy, you're whacking up interest rates, crippling people in your own economy. You are selling foreign currency reserves left, right, and centre. Speculators will watch you do this and think, hang on, there's no way they can maintain those high interest rates. There's no way that as an economy they can keep buying their own currency by selling foreign currency. It's going to run out at some point. So speculators will start selling pounds left, right, and centre. That will create a run on the economy's currency, and it will probably lead to the currency collapsing and having to abandon the fixed exchange rate system, which is what happened in Britain when we left the exchange rate mechanism. So in theory, well, fixed exchange rate systems have got some benefits, but in reality, they're very difficult to maintain because you lose control of your domestic fiscal and monetary policy.